Welcome everyone to this month's UPotential webinar. Today we're going to be discussing the difficulties that come from a two-income household, and this can be individuals who are married or common law, and I'd like to give you some strategies to help you resolve some of these dilemmas. Just a few housekeeping matters before we begin. As always, the webinar is being recorded and it's going to be made available online in the coming days. You'll likely receive an email survey after the webinar today, which will include a link to the recording. So if you feel the need to rewatch it or share it with your spouse or with a friend, I hope that you will. As always, I would also encourage you to send in questions or comments. There is a questions drop-down menu apparently available to you, and you can send those in along the way, and I will certainly try to address the questions at the end if time permits. Also, feel free to submit ideas for future webinars. I am going to be taking a summer break from webinar content in July and in August. But we have some amazing topics starting again in September that I'll let you know about at the end today. By way of introduction, for those of you who don't know me, my name is Monique Madan, and I'm a certified financial planner, financial management advisor, chartered financial divorce specialist, and as of yesterday, a registered retirement consultant. I've been in the financial industry for almost 20 years, and I've worked with a pretty broad variety of clients, from those who are very needy and lack mental capacity to the ultra high net worth. I guess in marketing terms, people ask who the target market is. I'm no marketing expert by any stretch, but in my experience, the people who have the most to gain from working with me are those who need help to prioritize their saving strategies. In other words, they might not be able to maximize their RRSP, TFSA, RRSP, and make aggressive mortgage payments, and they'd like to understand how to optimize their savings to get them to the desired outcome. Professionally, I am the head of financial life strategies for UPotential and ETF Capital Management. UPotential is a strictly fee-for-service financial planning firm where I give unbiased advice and strategy. In my role at ETF Capital Management, my services are available to the clients at no charge as part of the suite of client services that they can avail themselves of. Let me assure you, the strategy is the same, the service is the same. Unbiased advice on financial planning strategies that you might need, including retirement planning, tax planning, and so forth. On a related topic, which actually is about 180 degrees away from today's topic, I also have a specialized degree and experience working with divorcing couples. Now, with pandemic restrictions lifting slowly but surely, I hope that more people will be responsibly planning for life after isolation. Things like social gatherings and weddings will resume. Now, June is often thought of as the kickoff to wedding season, so I thought it would be a good time to look at how two people come together financially when they become a household. Now, we won't just be focusing on newlyweds, however, since even long married couples can have incompatible financial styles. And incompatible financial styles will often lead to conflict and often separation and divorce. I'd like to start off with a look at why arguments about money have always been around and how the increased number of two-income families has actually exacerbated the struggles when we really should have thought that more money coming into the household might mean fewer arguments. I then want to suggest a few strategies that can help you work through the financial struggles. Finally, I'd like to spend some time talking about one thing that research has shown can help couples at all stages of their cohabitation to come together and work towards a shared future. So let's get started by looking backwards to the way generations past used to handle money issues. In generations past, most affluent households would live off of one income, When these couples got together, it was assumed that one spouse would have a job or career and the other would raise the children or volunteer their time. Since there was only one income coming in, there was really no question as to how household expenses would get paid, how debts would be paid off, how children would be educated, and how the couple would save for retirement. Now, when this worked, it worked pretty well. The paycheck was deposited into a joint checking or savings account and bills were paid. But before you romanticize this time too much, remember that as often as not, one income meant that only one spouse had a voice with respect to larger expenditures and how wealth was going to be accumulated. In some cases, spouses were put on an allowance or made to feel as though they didn't deserve to spend money on things that made them happy because they weren't, quote unquote, contributing to the household kitty. In fact, in the area of family law, a concept called a constructive trust was created to acknowledge the contribution of the non-income earning spouse when it came to the division of assets. The argument of the constructive trust impresses upon the courts and opposing counsel that the professional or business success that one partner achieved is actually directly dependent on the other spouse's support and their ability to pick up the slack. With the women's liberation movement of the 1960s came the normalization of two-income households and therefore greater autonomy and power over one's own income. This is translated into more spouses who maintain their own bank accounts, so fewer joint accounts. Fast forward several decades, and this desire to avoid being dependent on someone has led to some pretty dramatic financial independence between spouses. But has it improved our household finance? The incomes may be separate, but how often do couples argue about how much they earn relative to one another? Or who's going to cover which expense? Or who makes a decision on a large purchase? I would argue that the pendulum really has swung a bit too far. During consultations, I'll often ask clients to consider, instead of independence, rather interdependence as the gold standard. While each spouse has their own income, I try to counsel clients to look at the differences between their earnings as an opportunity rather than a measuring stick. There may be a higher income earner and a lower income earner, but I think each has a role to play. Believe it or not, having a higher income earner and a lower income earner provides opportunities to take advantage of the tax refunds and other incentives that can be paid back into the family kitty, which then in turn enriches the household as a whole. There's no use in ignoring the fact that in most situations, spouses earn different amounts, and that often, well, I guess traditionally those differences could be quite vast. Perhaps, in the era of trying to get women to break glass ceilings, perhaps that difference is squashing a bit, and I certainly would hope it would. But any income discrepancy can be as a result of, different professional ambitions and opportunities, the necessity to take care of parents or elder or children. There may also be periods in our lives when we take a step back, perhaps to retrain or earn additional degrees, meaning that the income discrepancy might not be forever. Maybe it's short-lived. In any event, the income discrepancy can easily become a sore point in the relationship, especially if the tables have turned at some point in the union. Perhaps the higher income earner has fallen upon bad times, or the lower income earner's profession has been reassessed in society at a higher value. If you focus on the household or the family as a whole and prioritize taking care of one another, then money is really only one factor. In fact, the discrepancy can help the household in many ways. Having a higher income earner in the family can mean that the household can enjoy a higher standard of living. But this spouse is also likely to be prone to higher taxation because the Canadian tax system is structured in such a way that the more you earn, the higher tax rate you pay. Focusing on the benefit to the household then means that spouses who earn vastly different amounts should not contribute the same amounts to their RSPs. Instead, the money that is earmarked for RSP contributions should be first made in the hands of the higher income earner to give the household the best tax refund possible. If the higher income earner's RSP is maxed out, then the household can look at contributing to the lower income earner's RSP or each spouse's TFSA. But if possible, try to avoid investing funds in the non-registered account in the name of the higher income earner. In cases where the higher income earner can maximize everything, maximize the TFSA, maximize the RSP, and still has money left over, then he or she should consider taking on greater responsibilities for household expenses before developing any sort of a non-registered portfolio. The reason is that any investment income earned outside of these tax-efficient accounts would be punitively taxed in the hands of the higher income earner. In contrast, the lower income earner is often subject to lower taxation, which means that same RSP contribution won't attract as great a tax refund. The contributions, by the way, are still valuable, but from a strategic point of view, they should be made first by the higher income earner. One benefit, though, that the higher income earner can't take advantage of is the child care deduction, which is always applied against the taxes of the lower income earner. This is, of course, in a situation of two income households. If it's a one income household, then of course the child care deduction can be applied against your own income. In many instances, by the way, the child care deduction can be as valuable or more valuable than an RSP contribution. So do keep that as a consideration. If the lower income earner already has a juicy deduction by way of the child care deduction, perhaps now is not the time for RSP contributions as well. Now, in instances where the lower income earner doesn't produce what's called earned income under CRA's definition, he or she won't produce RSP contribution room. Earned income, by the way, is from things outside of employment. Earned income which produces RSP contribution is from employment and rental income. For someone who only collects dividends, they're not collecting or earning, quote unquote, RSP contribution room, so they won't get to be contributing to the RSP. Keep in mind, though, that irrespective of your employment status, TFSA contributions are available for both spouses as long as they're Canadians and over the age of 18. Remember then, in some ways, and I think we've talked about this in previous seminars, when deciding whether to make an RSP contribution or a TFSA contribution, you want to look at the relative tax burdens of both spouses, as well as projections into the future. If one spouse, for example, has an employer-sponsored pension that is going to secure for them a fairly sizable income during retirement, that person may very well want to contribute to the TFSA. Like having that technical earned income that takes away RSP contribution rooms, so too does the participation in a pension. So someone who participates, in the teacher's pension or in Ontario HOOP, for instance, may not have a lot of RSP contribution room. Again, for that person, don't forget, the power of the tax-free savings account. Now, you may recall that I've mentioned the Canada Revenue Agency's ability to reverse just about anything that looks like a tax avoidance strategy. They have kind of a catch-all mandate called the General Anti-Avoidance Rule, or GAR, that they can implement as an objection to the strategies that some people try to put forth. The most common error is called income attribution. And income attribution is the rule that allows CRA to reverse an investment strategy that's designed specifically to tax investment income in the hands of a lower income spouse when it's pretty obvious that the source of the money was the higher income spouse's employment income. You may have heard of income attribution as it relates to spousal RSPs. When spousal RSPs are done properly, the higher income earner, here depicted as the icon that is filled, will contribute to the account, the spousal RSP, and over time, it becomes the asset of the lower income spouse, who is depicted here as the icon that's empty. When the money is ultimately withdrawn, it's taxed in the hands of the lower income spouse, which achieves that income splitting benefit. Now that's perfectly fine as long as a mandatory waiting period has been observed. If not, the spousal RSP withdrawal is, and the term is, attributed back to the higher income earner for tax purposes. So for example, let's say a spousal RSP was made, contribution rather, was made in 2020. The money was contributed by the higher income earner, as it always is, into the spousal RSP in the name of the lower income spouse. The higher income earner, by design, has enjoyed a tax deduction on his or her 2020 tax return. But what happens if the lower income spouse, who again is the legal owner of the spousal RSP, withdraws the money the year after it's contributed? In this situation, the income would not be reported on the tax return of the withdrawer. I'm not even sure that's a word, but I'm going to use it, but attributed back to the contributor, because the minimum waiting period, which for spousal RSPs is 3 years, hasn't been respected. So income attribution rules can reverse your tax strategies. That's income attribution as it relates to an RSP. The same can happen in non-registered accounts. So imagine, for example, you have a couple. Again, the sort of filled piggy bank is the higher income earner. The empty piggy bank is the lower income earner, and they have vastly different income levels. Then, again, let's assume that the lower income earner has amassed a spectacular investment portfolio. This portfolio then in turn produces taxable investment income that you would like to be taxed in the hands of the lower income earner, right? Or is it? The Canada Revenue Agency could challenge this situation and demand that the couple show a paper trail that shows that the lower income earner invested his or her own income. If the challenge can't be defended, then the investment income would be attributed back to the higher income earner. Now, before you get nervous, just because a strategy can be challenged doesn't mean it can't be defended or legitimized. You may recall that I mentioned earlier that if a higher income earner has maxed out her RSP and TFSA room, rather than investing her income in a non-registered account, she could take on more of the household expenses, pay for the mortgage or a car lease. This naturally allows the lower income earner to save or invest in his or her income, which could conceivably over time amass a large portfolio. Just make sure that this is reasonable. CRA would likely question a situation where, for example, a spouse invests in excess of what he or she could reasonably have earned in that year. And if there are complicated circumstances, you probably want to speak with your accountant before you implement any strategies, just to avoid any audit challenges. Another way to combat income attribution is to have the higher income earner contribute to the lower income earner's tax-free savings account. Unlike RSP contributions, which really should be made with your own earnings, topping up your spouse's TFSA is a perfectly legitimate investment and income splitting strategy. In fact, if you've worked with me, you may have already heard me encourage families to even top up TFSAs for their adult children with non-registered holdings that would otherwise be taxed on the shoulders of the parents. This is a way of methodically transferring wealth to your kids in a tax-efficient manner. Another way to legitimately arrange it so that the lower income earner reports the non-registered investment income is for the couple to execute a prescribed rate loan. And again, I've mentioned these before. The loan has an interest rate that the government sets, and when the loan agreement is executed, that interest rate remains for the life of the loan, regardless of what prevailing interest rates are doing. The last time I checked, the prescribed rate was, I think, 1%, which is incredibly reasonable. So as long as the interest is paid by January 30th each year, any investment income produced in the account would be taxed in the hands of the lower income earner, which achieves your desired goal. And obviously, if you're covering only a small loan interest rate, 1%, it's feasible that the investment earnings could cover the loan interest with a net income profit to the lower income earner, thus growing wealth for the household more quickly and tax efficiently. For those of you who subscribe to Golden Girl Finance, you may have seen an article that I linked to, I don't think it was last week, I think it was the week before, and it discussed a very interesting idea called financial gaslighting. This essentially is it's often subtle, but the ways in which one spouse can gain control over the household's finances by, claiming to be an expert or having more knowledge than the other, or very often just having a stronger relationship with the accountant or investment advisor or financial planner. As professionals, there's no question we can certainly fall into this trap too. It's no question easier to have a conversation with a spouse who's vocal during a consultation. But this doesn't only do a disservice to the engagement, but it really does contribute to unhappiness and inequality in the relationship. To combat this, I personally try to engage the quieter spouse regularly and ask if he or she agrees with what's being talked about. Or often I will also ask the quieter spouse for his or her opinion first. And if this is a situation that you're in, I think you should recognize whether you're in this dance as well. And especially if you happen to be the financial spouse, if you are, really it is your responsibility to engage and encourage your partner. As we've discussed, we see where one income, one voice got people, and it didn't get them anywhere good. It got them straight to divorce court. There's no question that the two-income household is here to stay. So we better get an idea of how to manage to pay bills and growth wealth under this system. Now, this is a question that I'm asked all the time. The mechanics of how do people with two incomes, two bank accounts deal with common expenses. One option is a technique I call diversion, where the spouses deposit their income into one joint checking account and then divert an agreed upon amount automatically to their own personal accounts to allow them to spend, some money without requiring any input by the other spouse. The amount that's diverted can be determined either as, let's say, a set amount each month, $500 per month per spouse, or it could be proportional to the spouse's income. Let's say each spouse will divert 10% of his or her income to their own account. Either way, this is a really nice way to ensure that most of the money coming in is going towards common goals. And at the same time, my husband doesn't need to know how much I spend on his birthday gift or how much I spend on our dog. Well, it's really my dog, but anyway. Other clients will say that they deposit their employment earnings into a joint account, and shouldn't that protect you from income attribution rules? If the lower income earner invests money from this account? The question is, of course, once money is commingled, it gets muddied. There's no question. But if you can reasonably defend a challenge by the Canada Revenue Agency, then you're probably okay to invest directly from a joint account. Just don't expect CRA to sign off on a $100,000 investment by a spouse who's earning $40,000 per year, right? Unless money has accumulated over many, many years. Likely something like that is going to result in repercussions. The opposite technique is what I refer to as consolidation. In this technique, each spouse has his or her income deposited into a personal checking account and then sends money to the joint account to cover household expenses. Again, you could decide to send a percentage or a dollar amount. That's up to the two of you. But the advantage of this technique is that it's easy to prove that you are investing your own funds if you're making the contributions when the money is still at the individual account level, before it's been commingled into the joint account. So you have a clearer paper trail of the investments that you're making. Truth be told, either technique can be employed successfully and either technique can be abused. So if you are still using your income as a measuring stick to ensure that one spouse enjoys a higher standard of living than the other, then you're really not working together towards common goals. And unfortunately, I have had occasions where I've had to encourage clients to rethink their strategies and even sometimes seek counseling. So let's look at something that research has proven will help you work through financial planning difficulties and incompatibility. And of course, I'm referring to a financial plan. Now, please, I don't mean to be self-serving here. There are lots of financial counselors who can help you work through these difficulties, and I certainly would encourage you to seek help if you're in the situation. But the reason that financial planning is so effective at combating financial disagreements is that it gives you perspective that's awfully hard to have on your own. We work on sort of the longer term financial goals that you set and help to break them down into small, efficient strategies that you can employ today. It's interesting, that most financial planning software uses the euphemism of like either directions or a roadmap. A previous employer, we called the software Compass. And the reason is that encouraging individuals to look into their future and look at measurable pathways or stepping stones that can get them there really is a very useful analogy. If you ask most people, though, they will say that they'd be happy to prepare a financial plan, but as long as they don't have to do a budget. And I gotta say, I can't blame them. A budget feels patriarchal, not unlike the allowance the child receives, or that sometimes that stay-at-home spouse felt limited to in days gone by. But those of you who've worked with me know that we don't really do this. Fortunately, I use a very, very limited budget to gather information on clients. And the data that I collect really just has to do with costs of rent or maintaining your home and costs of transportation, because these are really fixed and stable expenses usually. Other expenses such as hobbies or eating out or personal spending, that's really just deduced by looking backwards at your take-home pay and comparing this to the amount that each individual saves. It's easy to assume that whatever hasn't been invested or saved has been spent. And you'd be surprised. This is a remarkably effective tool to uncover the household spending. Now, once I've gotten the budget phobic client on board, I focus on the big picture items like taxes and strategies that can harness the power of the higher versus the lower income spouse, including some of the ones that we talked about earlier today. Often, what I'm discussing isn't rocket science, but it does require a different perspective and the ability to do long-range projections in order to make some of those concepts clear. Nothing but nothing makes me happier than when clients walk away with greater clarity on their shared goals and, a feeling of empowerment to proceed. As a financial planner, I often uncover opportunities because, again, of that perspective that I provide. Any two people who are coming together bring their own individual quirks and experiences to this new relationship. Add a previous relationship and you get even more complexity. This type of blended family, where one spouse, let's say, has obligations to a previous family and has a new spouse who has kind of inherited these obligations, this can be incredibly difficult. But the perspective that we have together can uncover some real opportunities. Take, for example, a couple where one spouse, let's say, has obligations, support obligations of some sort to a previous family. It would be very difficult for this person in a new relationship to rebuild financially, and especially difficult to purchase a home in a large urban center. Now, I have countless encounters with couples who are trying to save for a home, and a large part of one spouse's earnings is supporting previous spouse and children. But with the experience and perspective that I can bring, I can often uncover that one spouse, typically, by the way, the one that wasn't in a previous relationship, can employ the home buyer's plan. Perhaps the previously married spouse has already taken advantage of it, and it's not available to that person unless they haven't owned a home that they lived in for 4 years. And sometimes it's up to me to remind the couple that the newly married spouse, who hasn't had a home in the past, can take advantage of this opportunity. And this can save them about $35,000 in additional borrowing by increasing the down payment that can be made. Another opportunity that I'm often encouraging couples to pursue is to have your taxes prepared by the same accountant so that retirement income splitting can be implemented effectively. Here too, you can take advantage of any of the discrepancy between your relative taxable incomes, but it's in a fluid manner. With the exception of CPP, just about all other forms of retirement income splitting are just done on the tax return. You don't need to make any changes to how the income is paid or to whose bank account the money lands. In fact, the proportion of RRSP income, or let's say your employer-sponsored pension, can be split each year in a different way based on what other income is being recognized by the spouses. Now, this can be really important when couples are coming together later in life. Often these couples will unite, but perhaps want to keep assets separate because they want to be able to bequeath them to their own children. And that's completely understandable. However, there's no need for fancy registrations to take advantage of income splitting. It's simply the tax preparer needs to know how much the spouses are earning relative to one another so that they can shift income between the two and save money to the household. Lastly, when I prepare a plan, I review beneficiary designations such as those on RSPs or TFSAs, pension plans, life insurance, and the like. Young individuals will often name their parents or siblings as their designated beneficiaries, and often they'll forget to update these documents when they become coupled. This can lead to a lot of problems in case someone suddenly falls ill or passes away. Now, some particularly employer-sponsored pensions will always default to the spouse as beneficiary, but there are lots of situations when the beneficiary has to be named, or otherwise it would default to whoever is on file or, to the estate. This is particularly important when we're talking about RSPs because upon death, unless you've named a spouse as a beneficiary, the entire account is taxed on the terminal return. So imagine, if you will, spouse 1 on the left has an RSP that names spouse 2 as the beneficiary. That's what we want to see. Spouse 2 on the right, however, has an RSP that still names his ex-husband. Okay, what happens if spouse 2 dies suddenly? This is an incredibly unfortunate situation. The RSP account gets paid in its entirety to the designated beneficiary, who is the ex-husband. What happens to the tax bill? The tax bill goes to the estate. But who's the estate? the current spouse. Can you imagine? Well, I can and I have. All the more reason to make sure that someone is taking a high level look at your estate plan and overall financial situation. Now, before I summarize and take questions, I thought I would share with you a recent court case that came before the Quebec courts. The case involved a law firm's shareholder who was trying to claim his daughter's wedding as a business expense. Now, to be fair, I have heard of situations in the past where couples were able to deduct some of the meals and bar costs and maybe even some of the costs of the entertainment that was consumed by attendees of the wedding who were business prospects. So this kind of piqued my interest. I wanted to look into it. In the case where wedding expenses were permitted as a business expense, the business owner was actively involved in selecting the guest list and making arrangements for where the guests would stay and how they'd get to the wedding. And they also could show a pretty clear link between revenue that was earned and relationships that were cultivated at the event. Okay, so this was heavily papered. In contrast, the Quebec case found that really, apart from the shareholder who was trying to claim the expense, no one was willing to go to bat for this person. No one was willing to testify to any business dealings attributable to the event, so the case was thrown out. So before you go and try to deduct your wedding expenses, speak to your accountant. It's just from the kind of, you can't make this stuff up file. Another recent development, by the way, is that apparently the Canada Revenue Agency has started to look at social media postings as a way to try to detect unreported income. Apparently, from what I heard from a reputable source, was that CRA has hired 60 agents to do what they're calling exploratory audits of social media postings. So this would be the kind of thing where you're boasting about a car you've purchased or a boat or a home. And then what they do is they compare this to the levels of income that's reported for tax purposes. Now, the truth is, I'm not sure that too many of us have vacation photos to share online right now, but just be careful that your online profile doesn't reveal income that you're not reporting for tax purposes. You really need to be able to defend the standard of living that you're portraying online. Just before we take any questions, let me summarize. Like so many things, as long as you're keeping your eyes on the prize, a strong and interdependent household where everyone is taking care of one another, the prospects for happiness and wealth can really be optimized. If you're using income as a measuring stick, just keep in mind that it's not always working in your favor anyway. An extra $10,000 earned by your lower income spouse actually nets the household more than an extra $10,000 earned by the higher income spouse because of the tax rates that are applied. Similarly, $10,000 invested in the hands of the higher income earner in a fully taxable account, let's say, doesn't grow as tax efficiently as those same dollars in the hands of the lower income earner. So we might as well celebrate the discrepancies and use them to the best advantage of the household. And lastly, like so many things, it's hard to make decisions when you're too close to a situation. And that's what I'm for. I'm a dispassionate observer I really have only one goal, which is to help you get what you want out of your money. So before I go ahead and tease our next seminar, which will be in September, I'm going to ask my colleague Josh if there are any questions that I can address. Okay, great first question. The question says, how often would you recommend revisiting a monthly household budget? I guess I would say that you should, if you find that you're overspending And of course, if we're talking about a 2-income household, I would probably want to dig a little bit deeper and say who is actually believing that the house is overspending. But let's assume for a minute that there is some concern about overspending. Then I would probably start, rather than looking retroactively, pulling out statements and trying to analyze things, I'd probably prefer to work proactively. And I do have a seminar that I delivered earlier in the year. It may in fact have been the first of the year, in which we talked about a reasonable proportion of savings and spending and debt payment. Okay, so let's assume that you're starting off with that point and then revisiting. I would think that the most frequent that I would ever suggest anyone look would be quarterly, because as you can appreciate, things happen every month. One month you have to pay for your life insurance premiums, the next month you need snow tires, things happen from month to month. So you need to look for trends. If you can do your budget every 6 months or a year, I think that would be ideal. But if you're in trouble and you feel like you need more close monitoring, then you might want to do it as often as quarterly. It's interesting to note also that the umbrella organization that UPotential is part of, which is something called Quintessence Wealth, they're coming up with a tool, which I will be trained on soon, and I look forward to sharing with clients, that is going to be able to give real-time feedback on spending, savings, investing, things of that nature. It may not, I haven't had a chance to really delve into it yet, so I don't know if it's quite the same data that you can get incidentally from your credit card. Some credit card offerers will actually give you a breakdown of how much you spent at the liquor store, how much you spent on Uber and things like that. I don't know that it'll go quite to that level, but it would help people stay on track. So maybe I'll see if I can't share some information about that in seminars to come. But back to the question on the frequency, semi-annually or annually, I think would be ideal. And again, if you need a little extra help, perhaps quarterly. Okay, a terrific question came up to clarify the issue of a higher income spouse contributing to a lower income spouse's TFSA, and whether this needs to be structured in such a manner as using the prescribed rate loan. And the answer is no. When the TFSA was initialized, it was introduced as a completely legitimate income splitting tool, meaning if there's extra money in the hands of the higher income earner, that person can use that money to top up the spouse's TFSA, and furthermore, as I mentioned, even adult children's TFSAs. So if we're looking at a household, it makes absolutely no sense for one spouse to have maximized a TFSA and be sitting on additional non-registered monies unless that money is earmarked for a purchase. If it isn't earmarked, it would probably be best placed in a TFSA. And if that person has no extra room, definitely loading up a spouse's TFSA. On that note, though, if you are looking to transfer non-registered monies that are already invested, keep in mind that prior to being put into the TFSA, the Canada Revenue Agency will consider that a tax event, meaning if you have X number of shares of TD Bank, for example, and you want to put them into your tax-free savings account where they're currently held in a non-registered account, you will have to pay tax on the appreciation of those shares from when you purchased them through to the date that they were placed into the TFSA before you can put them into the TFSA. You got to pay the tax before it basically disappears from the tax system inside the tax-free savings account. Another great question involving a prescribed rate loan. These are, again, loans between spouses, usually at a rate that's set by the government that lasts for the duration of the loan. And the question involves specifically how one goes about setting it up and if there are costs involved. So I did look into this because I actually received this question ahead of time. And again, I applaud the person who sent it and encourage you to continue to do so and others to do so as well. Essentially, if you work with a larger accounting firm, typically they will refer you to a lawyer to execute a prescribed rate loan document so that it's properly papered. Okay. There are, for smaller loans, some financial institutions, because I did get more than one answer about this, there are some financial institutions that do have templated trust agreements or loan agreements that can set this up for you. So I gather that it seems to me that the difference is the magnitude of the loan. If one spouse is lending $1 million to the lower income spouse in order to produce investment income taxed in the hands of the lower income spouse, if it's a sizable amount like I suggested, chances are you're going to want a lawyer to prepare it and there would be a cost associated with it. A smaller amount probably can be done at your financial institution. You would simply have to look at the financial institution and inquire about it. Going one step further, I also asked whether there would be any additional costs to report the income for tax purposes. So in a prescribed rate loan, the lower income spouse, as I mentioned, still has to pay that 1% interest rate. I think it's 1%. That's the last time I checked, to the higher income spouse in order to legitimize the loan. And that money has to be paid before January 30th of the following year and must be reported for tax purposes by the lender, who in this case is the higher income spouse. So I asked, are there any special forms? You know, often accountants will need to charge you extra for unusual forms involved in different things. And I was told that no, there are no special forms that need to be set up from a tax perspective. So really the only cost involved would be the cost of the agreement, again, if you need to go to a lawyer. And the difference between going to a lawyer and not probably has to do with the magnitude of the loan involved. Okay, I'm just going to look to see if there are any other questions that came in. Okay, looks like we're good. So let's get back to what we're all looking forward to, which is summer break. Now, I'm cautiously optimistic that people will hopefully spend some time over the summer catching up with people and maybe going on a road trip or two. So we're going to actually take a break from webinars for July and August. And September's webinar is going to be on the evolution of goals-based planning. And as always, if I can be of any service, please don't hesitate to contact me. All my contact information is in front of you. The UPotential website has lots of articles, all of our pre-recorded content. If you need to brush up on something or share it, please don't hesitate. Really, it would be my pleasure to help in any way that I can.